I was worried. Let's just stop the transcription quickly. All right. So carrying on now, we're currently on chapter 9. Okay, where from chapter 8, we were looking at the theory of demand. So again, demand is on the side of the consumer. Now we're moving on to supply, which is on the side of the producer. Okay, so we can understand this learning unit ties slightly into business management from a perspective of the producer, meaning what type of company is it? How is revenue calculated? How is costing calculated? All of those things then tie to a business perspective. So from business management, we're not looking at the type of company that we're working with, because that's business, sole proprietor, your CC, which doesn't, I mean, not really, we don't really have CCs anymore, but publicly listed companies, privately listed companies, those kind of things. That's from a business management perspective. From an economic perspective, from businesses, we're saying, how does your business now tie into the economy? Okay, so we all know, and I tell the students this upfront, that the government is not going to solve our problems, right? We in that situation at the moment. The government's supposed to provide jobs for everybody. They physically can't. So they are relying on the private sector, the business sector of the economy to create jobs. There's no other way to do it. You're also not studying the qual that you're studying with the intention of working for somebody for the rest of your life. That shouldn't be your aim. Okay, you should be looking at, how am I going to establish my business? But now we're saying, from an economic perspective, breaking up costing is not as simple as saying, okay, what is a cost? What do we do with it? What is revenue? We're saying it's a little bit more intricate than that. What does your business mean to society as a whole? Because that's the reality. And that's not something the government looks at all. Okay. So starting with the costing. So the goal of a firm, obviously, we all know what the goal of a firm is. Okay. Profit. As economists, we are not unrealistic to assume that the goal of a firm isn't profit. And then defining the various revenue, your cost and your profits, breaking that down a little bit more. So there's a little bit of a element here in terms of profit from an economic perspective and from an accounting perspective. So this is where, if you're an accountant and you understand the fundamentals of accounting, you're going to struggle with this idea or this concept a little bit. But economists, we're always special creatures. And then explaining the difference between a short run and long run in production theory. So here, I want you to understand that there's a difference between long term and short term and long run and short run. Okay. When we're saying short term and long term, we're talking about a period of time. Okay. But when we're looking at short run and long run, we're talking about variables, and I'll explain exactly what that means. So you can see it's the basic concepts you should know in terms of business management. But as economists, we just want to throw everything on its axis because that's what we do. Okay. Starting with the beginning, we all know that every single firm should have a mandate to become profitable. You don't establish a business if it's not with the intention to become profitable one day. Okay. But how we as economists see it is very different. Okay. So to us, a business that is making a profit, we see it as abnormal. We actually call it an abnormal profit. Okay. But a business that is breaking even, okay, so your revenue is equals to your cost. at the end of the day, we see that as a norm. We actually call it a normal profit. So the intention behind it is that if you are breaking even every month, you're making a normal profit. Understanding it comes from a government perspective, because a government entity isn't profit driven. They are not profit driven. Their revenue should equal their cost. Because remember, what they're bringing in terms of revenue comes from where? The taxpayer, right? And then they should be using the exact volume of money that SARS gets from us every month in terms of VAT, company taxes, all of the taxes that we have in our country. And they should be giving us goods and services to the value of that exact same amount, which means the government should be breaking even every month. They should be making what economists call a normal profit. But from a business's perspective, your intention isn't then to break even. That's your starting point, is to break even. Your ultimate intention is then to make what we call an abnormal profit, meaning your revenue has vastly exceed, or the idea is that your revenue should vastly exceed your costs. You're making an abnormal profit. Okay. So then I say to you again, there is the concept. We'll start with short run. And you can see there in red, I said it's not calendar periods here. We're not talking about calendar periods. When we're saying short term, I'm saying calendar period. If I'm saying short run, I'm saying within the short term, there's an element in the calculation that is fixed. There's some element that you are looking at that is fixed. Okay, and I'll give an example. I'll get to the long run. But I'll give an example, for example. So you have a business, you're well aware, you have this business. Okay, in that business, you have employees. Okay, but you also have a building, you have machinery, you have a business. We're saying one of those factors when you are calculating your revenue, whether you're calculating your costing, and it's mostly applicable to costing because it's the easiest entity to understand. But there's one element there that is fixed. So if I'm looking at it from a short-term perspective, usually we're saying the element that's fixed is it's either the land, meaning your rent. If you're renting the building, that's usually in the short run. It's fixed. It's going to be there. That cost is going to be there irrespective of whether you are producing or not. So if I produce nothing, I still have to pay rent. That element is fixed in my expense factor, okay? Or you can look at it from a context of employees, okay? Logically speaking, employees can vary because the number of employees you can bring in. But that element of you having staff can also be fixed, meaning you're paying labor every month. That is fixed regardless of whether you produce or you don't produce, whether they produce or they don't produce, or the business ultimately produces or doesn't produce. You're going to have that labor factor, which means you're paying laborers every month. That is a short run factor. At least one element within your production cycle is fixed. It's going to be there. But if we're looking at it from a long run perspective, which again then looks at it from a long term perspective, things will vary, meaning the volume will vary. I.e., if I'm saying employees was my fixed element in my short run, what can then happen to my employees in my long run? They resign, they retire. Okay, I can bring in new staff for capacity. So that element is still there. I still have to pay labor costs. But the volume of that cost, meaning the increase or the decrease, depending on how many staff members I have, that can vary over time. And that's what we're looking at here. At least in the short run, one element is fixed. In the long run, everything in your business can vary. Okay. And if you're looking at it from a rent perspective, where we're saying in the short run, my rent is fixed. But in my long run, what can happen to my rent? I can get a new building, which means my rent can increase. I can choose to buy a building, which means I'm not paying rent at all. I'm then owning the building. Okay. It becomes varied in the long run. Things can change in the long run, whereas in the short run, it might have been a fixed element. Okay. But if we're looking at short, long term, between a year going on 10 years, that's long term. So we're not looking at it from a time dimension. That's what we want to make clear to you. Okay. Revenue, please ignore the page number. I will still update the page numbers before I upload the slides. But from a revenue perspective, we know what revenue is, right? From a sales, we are we're logical creatures here. We can then ascertain to say your revenue is calculated as your price times your quantity. So the price of the product multiplied by the volume that gets sold. That gives us our total revenue. That does not change. From an economic perspective, we calculate that still exactly the same. Price times quantity, P times Q gives us our TR. Okay. We also look at the average revenue that we obtain. And then again, I said to you from Learning Unit 7, the word marginal is going to keep coming up and keep coming up in these chapters. Every element going forward is going to have some marginal, which means additional, another way of saying additional. Okay, so from your average, if we're looking at average revenue, why would we look at average revenue? Okay, we know what total revenue is. We're saying it's price times quantity. But why as a business would you then look at the average revenue? Because we're saying on average, if I had to sell a certain volume, I'd be making a certain amount of revenue. Okay, so revenue or average revenue is then the price times the quantity, which is ultimately total revenue. So we're saying that it's total revenue divided by the quantity. Okay, so that's our average revenue. So we're saying if all the units are sold at the same price, then the average revenue is equals to the price of the product. That's our aim, which logically also from a business's perspective might not always be the case. And then marginal revenue, we're saying for every additional, that's the additional part, the marginal, for every additional unit that is sold, unit meaning product that is sold, how much revenue are you generating? In understanding that the price of the product, how you come up with the price of the product as a business is different elements, right? You're going to look at how much did your materials cost? How much is your electricity? How much is your laborers? Da, 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 da. You're going to come up with a costing factor, right? And then break that up into, okay, divided by the units sold and all of that. And then you're going to end up with a price and you're like, right. And then obviously you're still going to add your markups and you're going to add all of those things because you want to make a profit obviously. Okay. So, but we're saying, okay, for every additional unit that you are selling of this product, what is the additional revenue that's coming in? Okay, and that's your marginal revenue. That's why it's always the triangle, meaning the change in our total revenue divided by the change in our quantity. The nice thing about this is that the change in the quantity will always be 1. Meaning I'm moving from, if I'm selling 1 unit of the product, I'm making a certain amount of revenue. If I'm selling 2 units of the product, I'm making a certain amount of revenue. If I'm selling 3, so it always goes 1 to 2, 2 to 3. That's the change in quantity. It's 1 to 2, 2 to 3, 3 to 4, and it keeps going like that. So the change in quantity will always be 1. So we're basically saying your marginal revenue, the formula for your marginal revenue is the change in your total revenue. And how you calculate your total revenue? The price times the quantity. Okay, so it keeps moving up and up and up. And then we're saying, okay, now we know what revenue is, and then So we're going to end up saying, your revenue less your costs. And then obviously as economists, we also look at costing very differently compared to an accountant. Right. We'll get to this slide. This is a very important concept, but we'll get to this slide a little bit later on. If I explain it now, it's going to throw you guys off completely. Right. So now we get to the cost side. So we did the revenue. Great. We understand how we've calculated revenue, price times quantity. Great stuff. Now we're looking at the costing side of it. Okay. Now, from a normal accounting perspective, when you're looking at costing, you're talking about the monetary value that gets assigned to expenditures, that basically is saying to you, what was the cost of me producing this product? Okay, that's the costing. Or you can't say remuneration, but the literal expense of the factors of production, utilizing those factors of production. Okay. And from an economist point of view, we literally call that explicit cost. It's the explicit cost, meaning the actual monetary value of your costing, of your factors of production. That's explicit. But now, because economists are cute, we don't do things like a normal. So you can see there, accounting looks at explicit. If I'm buying a machine, the machine costs 20,000 Rand, done. There's the 20,000. I've paid my owner. He gives me my machine. Great. I'm using the machine. Done. And then obviously as an accountant, you'll then still look at depreciation and you'll look at all of those weird and wonderful things. Great stuff. That's accounting. Economists, they're saying, no, 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 no. We can't just look at the monetary value. We also have to look at the opportunity costs. So what has your business then ultimately sacrificed in order to pay for that machine? So if you didn't pay that 20,000 Rand for that machine, what would your business have done with it? And logically speaking, from a business's perspective, if I'm not spending the money, I'm investing the money, meaning I would have received interest off of that money had I not purchased this machine. So I'm saying I can't just look at the machine itself, the expenditure of the machine, but I also have to look at making that trade-off to say, is this a viable option? Because I would have received the interest every month, which is revenue. So from an economist's point of view, we're saying an economic cost. We are looking at the monetary value and we're looking at the opportunity. Can everybody hear me? Sorry, it just dipped for a moment. I'm assuming everybody's fine.
Yes, now we can hear you. It was quiet.
Now you can hear. Okay, perfect. So I was saying the economic costs, right? Here we are, right at the top. The economic cost here, we're saying we're looking at the explicit, meaning the 20,000 Rand you would have spent on that machine itself, but we including the revenue you would have generated had you invested that 20,000 Rand, for example's sake. So it's explicit, the monetary value, plus the implicit, the opportunity cost. So we look at both elements, whereas an accountant is just saying, it's 20,000 Rand for the machine. There's your 20,000. Give me my machine. I'm done. Okay, so that's the difference between an accounting, and we call that an accounting cost, which is an explicit, the monetary value, versus an economic cost that's saying it's explicit and implicit, meaning the monetary value and the opportunity cost. Right. So that's the cost breaking. So just nice to see here. I don't think where we're saying we calculate total revenue from an accounting perspective on your left, and then an economic perspective on your right, because economists are always right and accountants are always wrong. Well, that's how I see it. To say that from an accounting perspective and an accounting profit, essentially, your revenue has to exceed your costs. That's an accounting profit. And based on how they calculate what cost is, they're saying it's the monetary value, the expenses, expenditure. That's how you calculate total revenue. Whereas from an economic perspective, we're saying you can't just look at the monetary value, the monetary expense. You also have to look at the implicit costs. So it's explicit and your implicit costs that give us our costing. And then ultimately that tells us if there's an economic profit, yes or no. And an economic profit to us is abnormal when you're saying your revenue exceeds your costs. Okay. And then there's a video, but you can do that at your own time, not my time. Okay, and this is where we're getting to now. From an economic perspective, okay, there's an economic profit, there's a normal profit, and an economic loss. Okay. From the textbook, and I didn't add it to the slides. I will update the slides because it is a new textbook. So this was obviously not in the previous edition, but I did check now. They also look at an element in terms of the costing, looking at costing to say, what happens if your business, you have a business like, let's say you make cigarettes, for example's sake. Or yeah, okay, cigarettes is a good business. Your business makes cigarettes, right? Now there's obviously the cost of physically producing these cigarettes. And then there's a lot of revenue generated from the production of these, or the selling of these cigarettes. Great stuff. But what also you have to look at in as a business owner is the type of product that you are manufacturing. So we call that, there's a private cost, meaning the physical cost of production, and there's a social cost as well. So the cost to society. So for example's sake, if you're manufacturing cigarettes and you know that people that smoke are historically going to get lung cancer, they're going to get sick, they're going to get asthma, they're going to get, there's these knock-on effects. So you can then see that if there's a correlation here between somebody smoking and somebody getting lung cancer, great. Does that person now have medical aid? No, they don't. So they're going to go to a government hospital. Great. Okay. The government hospital then gets funded by the government. Great. Who pays taxes? You do. So your business is then costing society as a whole, because now we have to fund government hospitals for people that are making choices based on the products you manufacturing. Okay. And the idea behind it is that you want your business, it's not always logical and it's not always possible, and we understand that, but you want your business to ultimately have a positive impact on society, not a negative impact. And where your business has a negative impact to society, that's when the government steps in and says, we are then going to add an additional tax, a sin tax, to your business because you have a negative impact to society. Okay. And they call that, it's on page 185 of the textbook. Like I said, I will update the slides, but on page 185 of the textbooks, they call that an externality. So you want a positive externality, and I'll explain the positive externality now, but your business, if you're manufacturing cigarettes, will have a negative externality, meaning a negative impact to society. Same with alcohol. If you're in the shebeen business, or okay, shebeen is little because you kind of third party. We see a shebeen as a third party entity because they don't physically produce the product, they just sell it. But should you be SAB, for example, say, SAB is a brilliant company, right? They manufacture almost all alcohol at this point, right? Great. But what is their cost to society? So they employing a lot of people, and then they're selling to wholesalers. Those wholesalers are generating they're generating obviously profits from the sale of this alcohol, but they're also creating jobs. Now it's a shipping company, it's a supply chain company. It had a knock on. So yes, they physically are not selling it to us. It goes through a Pick n Pay, it goes through a Shebeen, it goes through a restaurant, so it's going through a lot of different businesses. So yes, there is that positive entity or positive element to their production. They're doing very well for society, but us that choose, and I'm saying us, I'm not blaming anybody, but I'm just saying the overuse of alcohol, what happens? We drink a lot, cause an accident. Okay. Now, if you and you alone are involved in a car accident, there's very little cost to society. That cost kind of fell on you and you alone. Okay. But what happens in reality? Let's say you get behind the wheel of a car and you end up bumping a pole, let's say a robot, for example's sake, you bump the robot. That robot was funded by the government, which was funded by us. So now you're costing society because the government, you destroyed the robot. Okay, hope and pray everything you as a person is still okay, but you destroyed that robot. In destroying that robot, it's not like the government or the traffic department is going to come to you and give you a fine to say you destroyed the robot when you got behind the wheel of the car and you bumped that robot. They don't do that. They take on that cost. But in reality, we've paid for it because now the government does have to replace the robot. Same if there's an accident on the highway. We're all using the highway. You get behind the wheel of your car, you're impaired, you cause an accident, okay? And let's say it's a 2, 3, 4 car pileup. One of those cars is going to damage that highway, the barrier, the something, which is a cost to society. And that's what we're saying. So ultimately, all SAB did was manufacture the alcohol. But because there's a human element to everything, there's a cost to society, and you want your business to have a positive cost to society rather than a negative. And the thing about it is anything in excessive quantities tends to be negative. Okay, so a positive cost to society, I know it's easy for us to focus on the negative, but a business that's establishing a positive cost to society would be a Johnson & Johnson. Not talking about the baby products. I'm talking about, well, they do manufacture baby products, but the Johnson & Johnson and the Pfizer. So our, what's the word? Those companies, brain is escaping me now. But they manufacture medicine, pharmaceutical companies, that's the word. So our pharmaceutical companies, they are the ones that manufacture the COVID vaccines and all of that. Okay. Us as consumers, we didn't pay for those vaccines. We did, but we didn't. Okay. So the government took on the full expense of that. That's why so now they can't force everyone to get vaccinated because ultimately that's still your choice. And some people, for religious reasons, for personal reasons, whatever the case may be, opted not to get vaccinated. Okay. But the statistical element is that if they can at least get 60% or 70, pushing for 70% of the population to be vaccinated, the other 30%, because they are interacting with the 70%, the likelihood of them getting sick is lower, even though they are not vaccinated. So those kind of companies will have a positive externality because they have a positive impact on society. And companies like that, the government tends to take on the full expense of it. Hence, we didn't pay for those vaccines. So the government will, you can call it reward positive externality. So companies that have a positive impact on society versus taxing, sin taxing businesses that have a negative impact on society. Okay, so we also factor that into costing, right? So coming back to the slide now, we're saying we have economic costs, we have economic profit, sorry, economic profit, normal profit, and an economic loss. So our TR, total revenue, exceeds our total cost. So to an accountant, you just see that as profit. To an economist, we're saying it's an economic profit. Okay. And then a normal profit, total revenue, is equals to total costs. So in accounting terms, you would call that breaking even. To an economist, we will say that's a normal profit. That's what's supposed to happen because we are on the same notion as the government. We're not profit driven here. The idea is that the revenue should equal the cost. You're making a normal profit. You are essentially breaking even. And then an economic loss, which is a loss regardless of how you look at it from an accounting perspective or from a economic perspective, will always be at the point where our total costs exceeds our total revenue. In understanding that how we calculate total cost is always, and you can see it's always in brackets, to say it's explicit, the monetary cost plus the implicit, which is the opportunity cost. We actually add them both together to say, this is how we would then calculate our total costs. We don't just look at the monetary value, we look at the opportunity cost as well. Okay. And that is, so there's a lot of different examples here that I also run through just to help students understand. So it's very, very, very basic. We can then ascertain your total revenue being 100,000. You can see in brackets, I always start in brackets explaining the different concepts, but you can understand that when we ask the questions in the exam or anything, those brackets are not going to be there. We then make the assumption that you will know an explicit cost means an accounting cost and an implicit cost means an economic cost. So if we have our explicit cost, our accounting cost being 60,000, our implicit cost being 20,000, but our total revenue is then 100,000. Okay, so what exactly are we asking? If we say our accounting profit, we'd say our total revenue less our costs. But because accountants only look at explicit costs, it would be the 100,000 less the 60,000, giving you an accounting profit of 40,000. But if I had to ask you now, what is an economic profit? We'd say it's the 100,000. So we're acknowledging that total revenue is there, less the explicit, less the implicit, because we add explicit and implicit together in terms of the costing. And that means that your economic profit is actually only 20,000. But logically speaking, from a realistic and a business point of view, 40,000 is better than 20,000. We can logically say that. I mean, there's no way a business is actually going to say, oh, but the implicit cost is actually, no. From a business's perspective, they look at an accounting profit, but because this is economics, we hope and pray that you understand. Okay, so if we again say accounting now, an accounting profit, 20,000. But now, if we're looking at an economic profit based on the same numbers, so your total revenue being 100, your accounting costs 80, and then your economic costs being 20, we'd then say it's the 100 less the 80 less the 20, which will then equal 0. So your total revenue is equals to your total cost, which then means that you're not making an economic profit, you're making a normal profit, meaning you're breaking even. All the lecturers, I'm going to speak for myself, Are we strict on you saying normal profit versus break even? No, I'm not, because I know that you understand that your total costs and your total revenue are equal to each other. So I'm not too strict on you saying normal, unless the question explicitly says, is this a normal profit? Is this an accounting profit? Is this an economic? They'll always ask you, is it economic profit, normal profit, or economic loss? That they will establish with you, in which case then you can't say it's break even because you're not answering the question. Then you would say it's a normal profit. So it all depends on how the wording is phrased here. Okay. And then last element, obviously, an accounting profit using your total revenue being 100, your explicit 80, your implicit is 30. Accounting profit will just be your 100 less your 80, so it's 20,000. But from an economic perspective, we're going to say it's the 100, the total revenue, less the 80, which is our explicit, less the 30. So you're actually in a negative balance, which shows that you are making an economic loss. Essentially, you make, can you see, we can't just say loss, because from an accounting perspective, your cost, your explicit cost has not exceeded your total revenue. So it's not a loss. It's not an accounting loss. It's an economic loss because we are incorporating the economic cost into it, which is the opportunity cost. So this means that although the firm shows an accounting profit of 20,000 Rand, the entrepreneur could be earning more profit elsewhere. Because remember, it's the opportunity cost. So the cost of you making this accounting, having this accounting cost of 30,000 Rand, of 80,000 Rand, sorry. Okay, you could have been generating this additional 30,000 Rand somewhere as a potential revenue, but now because you haven't, i.e., let's say you did have a machine and this machine did cost you 80,000 Rand. Okay. Now we're saying if you didn't spend that 80,000 Rand on this machine, you could have been investing the money and earning, okay, it's not realistic, but earning the interest off of that money to the value of 30,000 Rand. Okay. And that's where we're saying it could have been an additional cost to you. And now, unfortunately for you, you're making an economic loss. But from an accounting perspective, you're still fine. Okay. Does that make sense to everyone? I know it throws the accountants completely on their heads at this point, because why would you look at this? But we're saying opportunity cost exists everywhere. For every decision we are making, there's an opportunity cost here. Okay. Just the last example. And this is more of I want to say this is more of a realistic example. Okay, where we're saying Sam inherits R1 million from his grandparent. We wish we were Sam at this point. He has the option to put the money in a savings account and earn interest of 10,000 Rand monthly. He could, however, decide to use his inheritance to start his own business. Great. What is Sam's implicit opportunity cost for starting the business? Okay, so we're saying it's the opportunity cost is essentially the 10,000 Rand. So he's sacrificing his implicit costs because he would have generated 10,000 Rand monthly. Okay, but currently the 10,000 Rand is his implicit cost. That's his opportunity cost. It's what he's sacrificing in order to start his business. But how much accounting profit should the firm make in order for the business to be a viable option to him? So we're saying it's his accounting profit of 10,000 Rand per month at least, in order for him, because that's his sacrifice. So he would have been getting his 10,000 Rand every month. Okay. For him to make this as a viable option, he must at least be generating an income to the value of 10,000 Rand so that he is breaking even. He's on a normal profit. Okay. So that's how I completely understand that it doesn't always make sense to the students. because we look at opportunity cost. But in terms of the calculations of all of this is a lot easier than understanding the concept. Okay. But if the firm then earns a profit of 5,000 Rand, he could then have earned more from the interest, which is his opportunity cost, compared to the revenue of the business. So if the business is only generating the 5,000 Rand every month, but the interest he would have received on keeping the R1,000,000 is 10,000 Rand a month, he shouldn't have started his business. He should have just invested the money. And we're saying that's how we want you to try and explain these concepts. Is this a viable option for the business? Yes or no? And you can't just look at it from Sam's perspective, which is actually starting the business. But anything, if you had to buy a big machine, what is the cost of that machine? Great, it's 80,000 Rand, whatever the case may be. But what would you have done with that? And realistically, from a business perspective, we're always saying, what would we have done with that money? We would have invested it. Otherwise, what else are you going to do? Okay. Or let's say you don't invest it and you choose to hire another staff member. That staff member has to bring in a certain volume of products that you can then sell, which will generate a certain amount of revenue. And you then need to look at it from that perspective of, is the opportunity cost of me buying the machine versus hiring a staff member? I need to then ascertain which one is going to be a more viable option. And to an accountant, it's clear. Go with the machine. Machines don't need lunch breaks, and machines don't need, an accountant will always say, go with the machine. But an economist will say, oh, but you want to grow your business and you want to do this and you want to do that, and then you need staff and you need. We will always look at the flip side of things. Okay. So we'll call it a night there, Shame. I feel very sorry for you guys that you just handed in your assignment and you must be tired, and we are the business end of the semester, and this module is still continuing like there's no tomorrow. But we will stop there for tonight, and then we will carry on because this chapter kind of it continues and